Hey guys, what is up? Welcome back to my channel, the best place to learn investing, trading, and the stock market. In this video, I'll be going to share with you the best bullish candlestick patterns so that you can use them in your candlestick trading. There are many bullish candlestick patterns out there that investors and traders use, but one of the biggest mistakes that traders who are starting out make is trying to memorize all these candlestick patterns and attempt to use them all. This usually doesn't end up well. It is better to have a small number of bullish candlestick patterns in your trading arsenal and being able to recognize them on your price chart rather than trying to memorize all these candlestick patterns but not actually being able to recognize and use them on your charts. That is why in this video, I'll be sharing with you 3 powerful bullish candlestick patterns that you can take away immediately after this video and use it in your candlestick pattern trading strategy. In this video, I'll be sharing with you candlestick patterns, so we are taking a look at 2 and 3 candlestick patterns. If you are just starting out on candlestick, you can check out my video on candlesticks for beginners here, where I share with you what individual candlestick means and how you can read them. So check that video out after you have watched this video so that you can maximize whatever you have learned in this video. Alright, let's dive into my computer and check out the first bullish candlestick pattern. First and most common bullish candlestick pattern I look for is the bullish engulfing pattern. So the bullish engulfing pattern is a 2 candlestick pattern and it can indicate a bullish reversal. There are 2 things that we look out for that helps us confirm a bullish engulfing pattern. So the first is that the first candlestick must be a bearish candlestick and the second candlestick must be a bullish candlestick. So the bearish candlestick must be followed by a bullish candlestick. That's the first thing that we want to look out for. The second thing that we want to look out for is that the second candlestick must be larger than the body of the bearish candlestick. As you can see on the picture on your screen, the body of the bullish candlestick is larger than the body of the bearish candlestick. So that is why we call it the bullish engulfing pattern, because the body of the bullish candlestick engulfs the body of the bearish candlestick. Ideally, we also want to see the body of the bullish candlestick to be larger than the whole bearish candlestick. That means larger than both the body and wicks of the bearish candlestick. But that is more a bonus than a criteria. So that's the 2 criteria we want to look out for in a bullish engulfing pattern. The first is that the first candlestick must be a bearish candlestick and the second candlestick a bullish candlestick. The second is that the body of the bullish candlestick must be larger than the body of the bearish candlestick. So how do we use the bullish engulfing pattern? There are 2 main ways to use the bullish engulfing pattern that I have found to have a higher probability of success. I like to tell my students that there is no one indicator that can give you a 100% success rate. We just need to find the indicators that give us a higher probability of success in the markets and using technical analysis and risk management so that when we win more than when we lose. We will be profitable in the stock market. So for the bullish candlestick patterns that I'll be sharing with you in this video, they will not give you a 100% win rate. That's for sure. The bullish engulfing pattern will not give you a 100% win rate, but what I discovered is that when we use the bullish engulfing pattern in these 2 ways, they give you a higher probability of success. And that is what we as traders want in the market. Not 100% success rate because that is not possible, but to have a higher probability of success in our trades. So the first way to use the bullish engulfing pattern with greater reliability and probability is to use it when prices have been on a downtrend and falling for a while, and it's close to a nearby support level. So check out my video on support and resistance to learn how to identify these levels and why they work in this video. So when prices have been on a downtrend and falling for a while, there is greater probability that prices will reverse and start to rise. This is because prices do not fall forever, and when prices are close to a support level, prices are more likely to reverse and start rising at a support level. And on top of this, if the bullish engulfing pattern, a bullish reversal pattern forms at this point, with all these patterns forming, there is greater probability that prices are likely to reverse into an uptrend when the bullish engulfing pattern appears. So the three signs we want to look out for are: first, prices have been falling for a while. The second is that there's a support level close by. And lastly, the formation of the bullish engulfing pattern. This is the first way we want to use the bullish engulfing pattern. The second way is when prices are on an uptrend and it is making a minor retracement. So prices is on a medium and long-term uptrend, but on a short-term downtrend. That is what we call a minor retracement. So when prices encounter a minor retracement and there is a support level close by and the bullish engulfing pattern forms, there is higher probability that prices are likely to continue the uptrend. So some of you may be wondering, Linus, do we really need all these additional criteria to use the bullish engulfing pattern? Can we use the bullish engulfing pattern by itself? I personally don't use the bullish engulfing pattern just by itself in isolation without taking a look at other indicators. I found through experience that whatever technical indicators I use, they give me a greater probability of success if I use them together rather than individually. So does this mean that I receive fewer signals and opportunities to enter the market? Definitely, but at the same time, every time I trade, I know that my probability of success is higher. So back to the question, do we really need all these additional criteria to use the bullish engulfing pattern? Yes, you need it if you want a higher probability of success. Okay, let's take a look at some examples on our price charts using the bullish engulfing pattern along with the other criteria. Alright, so on this price chart, can you identify where the bullish engulfing pattern is? Take a moment to pause the video and identify where the bullish engulfing pattern is. Alright, have you identified where it is? Great, so the bullish engulfing pattern is at this point. So this two candlestick. So remember, the two criteria that we want to look out for a bullish engulfing pattern is that the first candlestick must be a bearish candlestick. So this red candlestick is the bearish candlestick. The second candlestick must be a bullish candlestick. So this is the bullish candlestick. So that's the first criteria. So the second thing is that the body of the bullish candlestick must be larger and engulfing the body of the bearish candlestick. So can you see here that the body of the bullish candlestick is larger than the body of the bearish candlestick? So that is the two criteria that we want to look out for in a bullish engulfing pattern. So if the candlesticks meet those two criteria, we can say that it is a bullish engulfing pattern. So remember, one way we want to use the bullish engulfing pattern is when prices are on a downtrend for a while. So can you see that prices have been declining for a while? That's the first thing. The second thing is we want to see that the bullish engulfing pattern forms at a support level close by. So can you see there's a support level here? So the first test was this one. So 1, 2, and 3. So that is the support level. So when a bullish engulfing pattern appears on a support level and after prices have been declining for a while, it gives us a greater probability that prices are likely to rise in the near future. So can you see that after a bullish engulfing pattern appears, what happened to prices? Prices start to rise, right? So it rose for a while, then it moves sideways for a while also, and then after that it starts to pick up and start to rise all the way. So that is one way we want to use the bullish engulfing pattern. The second bullish candlestick pattern that we will take a look at is the morning star pattern. The morning star pattern has 3 candlesticks, so it is a 3 candlestick pattern. The first candlestick in the morning star pattern is a bearish candlestick, followed by a doji candlestick, and lastly a bullish candlestick. That's the first thing we want to look out for in a morning star pattern. The second thing we want to look out for is that there must be a space or gap between the bodies of the bearish and doji candlestick, and a gap between the bodies of the doji candlestick and bullish candlestick. If the candlestick pattern meets these two criteria, then we say that it is a morning star pattern. Remember that we want to use candlestick patterns along with other indicators and not in isolation. The morning star pattern is no exception. So what other indicators we want to look out for that can give us a greater probability of success? So similar with the bullish engulfing pattern, we want to see that prices have been falling and on a downtrend for a while, and that there is a nearby support level. And the last one is the formation of the morning star pattern. When we see these 3 indicators appearing together, This gives us a very strong signal and probability that prices are likely to turn bullish and start rising. The second way is when prices are on a medium and or long-term uptrend and prices are making a minor retracement and there is a support level close by. And if the morning star appears, there is a greater probability that prices will reverse from a temporary and minor downtrend and back into an uptrend. Now that we have known how to identify a morning star pattern and what other indicators we want to look out for and use along with the morning star pattern, let's take a look at our price charts and see how we can use the morning star pattern. Alright, so for this price chart, can you identify where the morning star pattern is? Great, so the morning star pattern is here, right? So we have the first candlestick being a bearish candlestick followed by a doji candlestick followed by a bullish candlestick. So that's the first criteria in the morning star pattern. The second criteria is that there must be a gap between the bodies of the bearish and doji candlestick. So can you see there's a gap? And there must be a gap between the doji candlestick and the bullish candlestick. So can you see there's also a gap? So with those two criteria, we can safely say that that pattern, that three candlesticks, form a morning star pattern. So remember, one of the ways that we want to use the morning star pattern is when prices are on an uptrend and is making a minor retracement. So can you see that prices are on an uptrend for a while? So how do we tell when that prices are on an uptrend for a while? We can tell by the moving averages. So you can see that the shorter term moving average is above the longer term moving average. So when the shorter term moving average is above the longer term moving average, it indicates to us an uptrend. So we can say that prices are on an uptrend for a while. So how do we tell that prices are making a minor retracement? So can you see that prices have rose for a while and then recently prices start to decline a bit. So this decline for a bit is like a minor retracement because we know that prices do not go all the way up or do not go up in a straight line. It usually goes up, goes down, goes up and goes down in an uptrend. So prices do not always go up. So in a minor retracement, prices go down for a while. So when prices are on an uptrend and prices make a minor retracement on this uptrend and a morning star pattern forms, can you see what happens after that? There's a greater probability that prices are likely to rise after the morning star pattern forms. So can you see after the morning star pattern is formed, prices start to rise, right? So that is one way we want to use the morning star pattern. Let's take a look at another chart. So on this chart, can you identify where the morning star pattern is? Right, so the morning star pattern is here. So the first candlestick is a bearish candlestick followed by a doji candlestick and a bullish candlestick. So for this example, prices are on a downtrend. So how do we know that prices are on a downtrend? So we can tell that when the shorter term moving average is below the longer term moving average, that prices are on a downtrend. So when prices are on downtrend and the morning star pattern forms, it gives us greater probability that prices are likely to rise in the future. So can you see that after the morning star pattern forms and when prices are on downtrend and the morning star pattern forms, can you see what happened to prices after that? Prices start to rise after that. So prices rose for quite a bit after that. So that is another way we want to use the morning star pattern. For the third bullish candlestick pattern, we want to take a look at the three white soldier pattern. The three white soldier pattern is a bullish candlestick pattern as it has three consecutive bullish candlesticks forming back to back in 3 straight days. So it is a very strong bullish candlestick pattern. The second thing we want to look out for is that the bullish candlestick must open within the body of the previous day candlestick and close above the previous day's candlestick. Like the bullish engulfing and morning star pattern, we want to see the three white soldier pattern forming after prices have been declining for a while with a support level close by and the three white soldier pattern appearing. The next pattern that we want to take a look out for is when prices are on a medium and long-term uptrend and is making a minor retracement with a support level close by. And when the three white soldier pattern appears alongside with these other indicators, it will give a greater probability that prices will start reversing into an uptrend. So those are the two ways that we can use the three white soldier pattern. Let's take a look at our price charts and see how they work in real life. For this price chart, can you identify where the 3 white soldier pattern is? Right, so the 3 white soldier pattern is here. So the first thing we want to take a look at is that there must be 3 consecutive bullish candlesticks. So this is 1, 2, and 3. So that's the first criteria. The second criteria is that the body of the bullish candlestick must open within the body of the previous day candlestick and close higher than the previous day candlestick. So you can see this one opens within the body of this one and it closes higher than this candlestick. So this one, it opens within the body of this one and close above the body of the previous day's candlestick. So if those 2 criteria are met, then we say that the 3 candlestick is a 3 white soldier pattern. So for this example, we see that prices are on an uptrend because the shorter term moving average is above the longer term moving average, and that prices have made a minor retracement. So with these 2 indicators in place, and when the 3 white soldier pattern form, what does it indicate to us? It indicates that prices are likely to rise in the future, right? So can you see that after this pattern is formed, after the 3 white soldier pattern is formed, prices start to rise for a while, then it declined for a while, but after it declined for a while, it continued to rise. So when the 3 white soldier pattern forms on top of a uptrend, and when prices are on an uptrend and making a minor retracement, with the 3 white soldier pattern forming, it gives us a greater indication and probability that prices are likely to rise over time. So that is one way we want to use the 3 white soldier pattern. Let's take a look at another way we can use the 3 white soldier pattern. So on this price chart, can you identify where the 3 white soldier pattern is? Take some time because this price chart is contains quite a lot of candlesticks. Alright, so have you identified where the 3 white soldier pattern is? It's here, right? So the first candlestick, so there's 3 consecutive bullish candlestick, and the second candlestick opens within the body of the first candlestick and close above it. The third candlestick opens within the body of the second and closes above the second candlestick. So those 2 criteria, so when those 2 criteria are met, we say that it's a 3 white soldier pattern. So for this example, prices are on a downtrend. So how do we know prices are on a downtrend? Can you see that prices have been declining for a while? So that's one way to tell. The other way is to use the moving average. So can you see the shorter term moving average is below the longer term moving average? So that is how we tell that prices are on a downtrend. So when prices are on a downtrend and the 3 white soldier pattern form, what does it indicate to us? It indicates to us that prices have a greater probability that it will rise in the future, right? So can you see that after the 3 white soldier pattern form, what happened to prices? Prices start to rise by a lot, right? So that is another way we want to use the 3 white soldier pattern. We want to use it when prices are on a downtrend, and when prices are on downtrend, the 3 white soldier pattern form. Then with these 2 in place, it gives us a greater probability that prices are likely to rise in the future. So those are the 3 bullish candlestick patterns that I've used successfully in the stock market. I have intentionally included just 3 bullish candlestick patterns so that you can grasp and implement them immediately in your trading. It is better to be a master at a few rather than a jack of all trades. That is my aim for you in this video, and I hope that I have achieved that with this video. If you have learned something from this video, give it a thumbs up and comment what is your biggest takeaway from this video and what other technical analysis videos you want me to create. I'll see you in the other videos, and if you haven't already subscribed to my channel, make sure you click on that subscribe button and turn on the notification bell so that you don't miss out on any future videos. To your financial success.